Hey guys, welcome back to Module 5. Here we're going to be looking at revenue recognition, receivables, operating expenses, and really just understanding revenue is more complicated than it looks. So in our previous module, we focused on analyzing financial statements and using ratios to understand business performances. But in this module, we're going to look more closely at one of the most important numbers on the income statement, and that's revenue. So at first, revenue seems simple. A company sells something, receives money, and records revenue. But as we've already seen, accounting isn't always that straightforward. Companies frequently sell products on credit. Customers must pay before or after goods and services are delivered. Some customers won't pay at all. Companies also to estimate certain expenses and obligations before the exact amounts are known. So our focus in this module is not just how much revenue did the company report. Instead, I want you asking, how is that revenue generated? When was it generated? And how much will actually be collected? And what estimates did management make in arriving at the reported numbers? Those are much more useful questions from a manager's perspective. So when we talk about revenue recognition, under accrual accounting, revenue is recognized when the company's earned it, not necessarily when the cash is received. And that distinction should sound pretty familiar by now because we've been talking about it in earlier modules. But a company can receive cash before recognizing revenue, and it can recognize revenue before receiving cash, or the two can occur at approximately the same time. The key issue is determining when the company's performance obligation to the customer has been satisfied. Think about a retailer. If you walk into a store, purchase an item, pay for it, and leave with the product, the transaction is relatively straightforward. But imagine a company signs a contract to provide services over the next 12 months and receives payment up front. It has received cash, but it hasn't necessarily earned all of the revenue yet. So the difference matters because the timing of the revenue recognition directly affects reporting. The timing of revenue recognition directly affects reported profitability. So from a manager's perspective, why should managers care about revenue recognition? So imagine two companies each report about $100 million in revenue. At first glance, they appear comparable, but suppose company A has already collected most of its revenue in cash, and company B has recognized much of its revenue on credit and is still waiting for customers to pay. Those companies may have identical reported revenue, but very different cash flow and collection risks. That's why a manager or investor should never stop at the revenue number. You need to ask, how was the revenue generated? How much has been collected? What remains in accounts receivable? And are those receivables likely to be collected? When we're talking about part of the accounts receivable, when a company earns revenue but allows the customers to pay later, it generally records the accounts receivable. Accounts receivable are assets because they represent amounts the company expects to collect from customers. But there's an important complication. Not every customer will pay. Customers know from experience that some portion of their receivables will ultimately become uncollectible. Accounting, therefore, requires companies to eliminate those potential losses. Rather than waiting until a particular customer definitely fails to pay, companies recognize an estimate of expected credit losses. So it's an important example of the role estimation and managerial judgment play in financial reporting. For allowance for credit losses, accounts receivable are generally reported at the end, at the amount the company expects to collect. Conceptually, we think about it this way. There's gross accounts receivable minus allowances for credit losses, people don't pay their bills, equals your net accounts receivable. So suppose customers owe a company $10 million, but management estimates that about $400,000 will not be collected. The company would therefore report an approximately 9.6 million as net accounts receivable. And the reason we do this is because reporting the entire 10 million as though every dollar were collectible would overstate the economic value of the receivable. That allowance gives financial statement users a more realistic estimate of what the company expects to collect. So estimation matters. The allowance for credit losses is an estimate. Management doesn't know with absolute certainty which customers will ultimately pay. It must make assumptions based on information such as historical collection experience, customer credit quality, economic conditions, the age of receivables, and expectations about future collections. So that means that two companies with similar receivables could potentially report different allowances if their customers or expectations differ. That doesn't necessarily mean that one company is manipulating the numbers. Accounting frequently requires judgment, but it does mean that analysts should pay attention to changes in estimate. Looking at it from a management standpoint, revenue is growing. Is that good news? Suppose your company reports revenue increased by about 15%. Sounds excellent. But now you discover accounts receivable increased 40%. Would that change your reaction? It should at least make you ask questions. Perhaps sales grew rapidly near the end of the year end and customers simply haven't paid yet. That may be perfectly reasonable, but perhaps customers are taking longer to pay. Maybe credit standards have become too loose. Maybe the company is extending generous payment terms simply to generate additional sales, or perhaps some customers are experiencing financial difficulty. The point isn't that increasing receivables is automatically bad. The point is revenue growth should be evaluated together with the quality and collectability of that revenue. So receivables and operating efficiency. Remember the days sales outstanding that we discussed in chapter 4. Days sales outstanding helps us think about how long it takes the company to collect from customers. If the DSO increases significantly, managers should investigate. Are customers paying more slowly? Did payment terms change? Did the company's customer mix change? Is the company intentionally offering more generous credit terms to increase sales? A longer collection period may be a warning sign, but it could also be the result of a deliberate business strategy. Again, the ratio identifies the issue. Management must explain why it happened. The bad debts and write-offs. So eventually, some receivables may become clearly uncollectible. When that happens, the company writes off the individual account against the allowance that was previously established. There's an important conceptual point here. The company does not necessarily wait until the final write-off to recognize the economic loss. The expected loss was estimated through the allowance process. This is consistent with accrual accounting. We want the financial statements to reflect the economic effect of expected credit losses in the appropriate period rather than waiting until the cash is unquestionably lost. Operating expenses and estimates. The chapter also moves beyond receivables into operating expenses. Operating expenses include many of the costs required to run the company's business. Some are relatively straightforward, others require significant estimates, and one useful example is warranties. Suppose a company sells products with a warranty. The company makes the sale today, but some warranty repairs won't occur until next year. Does the company wait until next year to recognize all of those warranty costs? Generally, no. If the company expects warranty costs as a result of the current sales, it estimates the future obligation and recognizes the related expense. That gives us another example of accrual accounting. The economic obligation may exist before the cash payment occurs. When we talk about contingencies, sometimes a company faces an uncertain future obligation known as a contingency. A lawsuit is a common example. At year end, a company may be involved in litigation, but no one knows exactly how the case will be resolved. Accounting has to determine whether the potential obligation should be recognized in the financial statements or disclosed in the notes, or potentially neither, depending on the circumstances. You don't need to become attorneys or auditors here. The larger lesson is that financial reporting contains uncertainty. Some reported amounts are known, and others depend on management's best estimate of future outcomes. Looking at this from a manager's standpoint, you looking behind the estimate. Suppose the company's reported profit suddenly improves. One possibility is that the underlying business genuinely improved, but an analyst should ask, did any important estimates change? Did management reduce its allowance for credit losses? Did estimated warranty costs decline? Did assumptions about contingent obligations change? Again, this doesn't mean changes in estimates are improper. Estimates should change when economic conditions change. But managers and analysts should understand which portions of reported performance are driven by business activity and which are affected by accounting estimates. The distinction will become important when we evaluate earnings quality. So, sort of trying to connect this chapter to the financial statements. Suppose a company makes a credit sale and revenue appears on the income statement. Accounts receivable increases on the balance sheet. If the company expects some customers not to pay, bad debt or credit loss expenses begin to affect the income statement, while the allowance affects the net amount of receivables reported on the balance sheet. When customers eventually pay, cash increases and accounts receivable decrease. These collections also affect the company's operating cash flows. So once again, we're seeing why the financial statements should not be analyzed independently. A single business activity can affect multiple statements. So really what we're trying to take away from this module, first you need to understand that revenue recognition and cash collection are not the same thing. Revenue is recognized according to accrual accounting, not simply when cash arrives. Secondly, you need to understand why accounts receivable arise and why companies do not expect to collect every single dollar the customers owe. The next thing is you need to understand the purpose of the allowance for credit losses. Accounts receivable should reflect the amount of the company realistically expects to collect. It's also important to recognize that financial accounting frequently requires estimates and managerial judgment. So credit losses, warranties, and contingencies are a good example of these kind of estimates and good judgment. The fifth thing, we need to also connect receivables to operating performance and cash flow. If revenue is growing much faster than collections, managers should understand why. And as a manager, you don't simply ask, did revenue increase? That's not a good manager. You need to ask, what is the quality of that revenue? Are customers paying? What assumptions did management make? Are those assumptions reasonable? And what does all of this tell us about the underlying business? Those questions take us beyond reading the financial statements toward actually analyzing financial performance. So Module 6 will continue building on this foundation by examining another major area of the financial statements and the decisions managers make around those resources.